Dear student, Assalamu alaikum. I hope all of you are fine by the grace of Almighty Allah. Dear student, I am Muhammad Shah Jahan, Assistant Professor, Department of Accounting, Milestone College, Uttara, Dhaka. Dear student, this is our first lecture on chapter 6, and all of you know that this is accounting for receivable. Dear student, today we will discuss accounting for receivable chapter. Dear student, after this lecture, you are able to have an idea about account receivable. You will have an idea about classes of account receivable. You will have an idea about bad debt and allowance for doubtful debt. And you will have an idea about recording process of bad debt and allowance for doubtful debt. Dear student, account receivable. Account receivable is the balance of money due to a firm for goods or services delivered or used but not yet paid for by customers. That means you sold goods to somebody, you give service to somebody. Instead of that, that customer are must paid some money, but yet not he paid the money. So this type of customer are your account receivable. This type of customer are account receivable. That means if we sold goods on credit, if we give service on credit, that time account receivable created. Dear student, account receivable are listed on the balance sheet as current asset. That means account receivable is a current asset account. Dear student, journal entries for account receivable. That means how account receivable created. Look at account receivable, account debit, sales account, credit. That means if you sold goods on credit, that time only account receivable may create. I hope all of you understand. Dear student, now types of receivable, classes of receivable. Dear student, receivable are three types. Number one, account receivable, which I have discussed earlier, the name of this chapter. Note receivable, then other receivable. Number one, account receivable. If we sold goods on credit, that is account receivable. And dear student, that means account receivable created from sales. On the other hand, note receivable, it is created from account receivable. That means out of this account receivable, if we have an agreement with any businessman, and where the specific date is mentioned when I will get the money, then it become note receivable. That means note receivable is a contract with account receivable holder, then he will when he will pay our money. And dear student, now other receivable are loan to others, settlement amount due for non-current asset sales, rent receivable, advance salary and allowance, interest and dividend receivable, income tax return. These are the different types of receivable. I hope, dear student, all of you understand about the types of receivable. Now, bad debt and allowance for bad debt. Dear student, from the account receivable, these two items may create bad debt and allowance for bad debt. What is bad debt? Bad debt is an expenses that a business incurs once the repayment of credit previously extended to a customer is estimated to be uncollectible. That means, dear student, earlier I have told that when I sold goods, this is account receivable, and out of that account receivable, if any amount is doubtful, that means we may not get the amount of money, that estimated estimation of uncollectible amount is known as bad debt. Dear student, now allowance. An allowance for doubtful account is a contra asset account that nets against the total receivables presented on the balance sheet. That means it is created against the receivable to reflect only the amount expected to be paid. How much amount I will get, that it will reflect that one. The allowance for doubtful account is only an estimate. It is not actual. It is an estimate of the amount of account receivable which are expected not to be collected. That means the amount which we may not collectible, which amount it is allowance for doubtful debt. If we keep any provision for that money, then it is allowance for bad debt. Dear student, now recording process. Dear student, this is most important. All of you must memorize, all of you must understand. If you have any types of confusion on this, then you cannot clear this chapter. So if any types of confusion in any time, of course you will ask to us. Dear student, uh, recording process, you know that recording process means journal. So how will record sales on credit? If we sold goods on credit, account receivable debit, sales or service revenue credit, that is recording process of sales on credit. Then if there is any sales return, I sold goods but the customer may not like it, he may return it. So in the journal is sales return debit, account receivable credit, sales return account debit, account receivable credit. Then next one, receive from account receivable. If we get money from that sales, that receivable, then cash account debit. If there is any discount, this is optional. If there is any discount in the math, then discount account debit, then account receivable credit. That means this is discount is optional. If there is discount related with that transaction, then discount debit. Otherwise, cash debit, account receivable credit. Then dear student, return of account receivable. If you would like to write off, if you would like to remove account receivable some amount, then the journal is allowance for doubtful debt debit, account receivable credit. Allowance for doubtful debt, it is debit, and account receivable, that means account receivable is decreasing. Then to create allowance, that means we know that some amount we will not get, therefore for creating that allowance, bad debt expenses debit, allowance for doubtful debt credit. Bad debt expenses debit, allows for doubtful debt credit. Dear student, bad debt expenses, there is a formula for calculating bad debt expenses. It is bad debt plus new bad debt plus new provision minus old provision. You may write, dear student, you may write. Last class also I have discussed bad debt plus new bad debt. Sorry, in the financial statement class I have discussed bad debt plus new bad debt plus new provision minus old provision, then you will get bad debt expenses. Bad debt expenses debit, allowance for doubtful debt credit. Then to close the bad debt expenses, income statement debit, bad debt expenses credit, income statement debit, bad debt expenses credit. Dear student, now to restore return of account receivable, that means earlier it was account receivable, now we would like to restore. We may get that money, that's why we restore it. Account receivable debit, allowance for doubtful debt credit. That means earlier when we close the account receivable, that time allowance for doubtful debt was debit and account receivable was credit. Now account receivable debit because it is asset, our asset increasing, and allowance for doubtful debt credit. Now you receive this money from account doubtful debt, cash account debit, account receivable account credit. Dear student, this 8 formula is the most important formula for this chapter. Of course you learn, you will understand, you would like to try to understand. If you have any types of confusion, any types of doubt, of course you will share with us. Dear student, thank you very much. May Allah help all of us.